Good afternoon, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms, and I'm back to talk about our stock market investment strategy using closed-end funds. Disclaimers to get out of the way. This is an unedited video. Notice what you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a strategist and a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So when we started this journey with our brokers and fiduciaries, we progressed to tackling the retirement battle ourselves. When I started self-directing, I used our last wealth advisor as a benchmark for dividends. I just wanted to beat his dividend mark with less invested. It was pretty easy because we had very different strategies. But once we blew past that, my confidence grew a lot. And simultaneously, the more I read, the more I listened, the more I strategized, for lack of a better word, but the more I did on our own behalf, the more concerned I became with him managing our money. Our strategies were very different. It was the traditional broker with outdated strategies, outdated, what I would term outdated strategies. He, like our fiduciary before him, proved Robert Kiyosaki's claim true that brokers leave you broker than them. And fiduciary just means that you're supposed to do the best you can with somebody else's money. HOAs are that way. Most brokerages are that way. If you watch the Fisher investment commercials, which we don't use, Fisher and Schwab and others make these commercials about doing the best things for your money. But at this, and I'm all for paying a fiduciary or anybody else a worthwhile fee. I mean, they're shepherding your money. They're supposed to, but most brokers actually leave you broker than they are because they follow failed strategies, right? I mean, the strategies suck. I've been over them. The 4% rule is shit. The 60/40 stocks to bond plan is bad. Investing solely for equity gains over time is trash. Investments. Inflation, regardless of what the Fed says, is really 4% a year. And when they say it's 4%, it's more than 4%. And you can look at overall portfolio value. Like it's good to know what you have invested, right? But the overall value of your portfolio, it's an easy number to track. But if that's your only metric, it really doesn't matter until you sell. And in the case of equities, you're selling your value to pay for retirement. And that sounds like a horrible strategy. At least it does to me. So in that effect, that poor strategy or maybe outdated strategy that's compounded against you when you're using those other failed strategies. So I mean, think of this: why are so many retired people coming back into the workforce? Because their retirement portfolios aren't lasting, and that's not what we want. So we're doing it differently. So each week, I rehash recent financial news before deep diving our closed-end fund master list, and then sorting that based on specific metrics to find the best deals in the current market. Overall, we're playing the long game and using a short game when needed. It's neither buy and hold, or say it's neither a straight buy and hold, set it and forget it strategy, nor a quick flip mentality. We navigating the stock market is like swimming or sailing a ship. You need a decent map. Or say if you're swimming, like if you're going to a beach you've never been to before, it would probably serve you best to look at some type of map, even if it's a Google map, because it would give you just a general outlay of the land, right? In sailing, you need a decent map. You need to know where you're going. You need to pay attention to all the markers. And then it still comes down to making those decisions, but you need a decent map, right? Or a starting point of understanding with a destination in mind. You need to know the tides. Is it high tide or low tide? Is it changing tide? Is there a storm approaching? You've got to feel the currents and navigate the currents. You've got to work your way through the shallows and the deeper waters. And then there are sandbars. You've got to be cautious and fearless. You've got to feel your way through it. and also know where you want to go. And if you can't justify a move, it's probably not a risk worth taking. And sometimes you have to be willing to take a well calculated risk and go where others aren't. I mean, the tide, I'm going to get off course quick. Tides play a huge role, really just going on a boat. I mean, you can easily scrape your boat over coral and a reef on low tide, right? But you would see it. You can easily avoid it. But on high tide, it's a lot harder to see. You have to know it's there, or you have to have been there before, right? And in fishing, especially, there are pockets and isolated places you can get to if you know how to navigate, or if you know where the hazards are, so where you can reach your destination knowing the hazards you're going to encounter along the way. Investing in the stock market, I mean, pick an analogy, swimming or boating or fishing or hunting or anything, right? It's more than just picking stocks. You've got to be able to, you got to be willing to sift through a lot of data and f- both feel and know the current financial swing of things, or the tide of things, and then be able to put that information in motion. So we want to use the current financial markets, like whatever the Fed's doing, and the goings on of each administration, and the housing market and the energy market and the oil market, and et cetera, and et cetera, and et cetera. And then we also want to use the herd's mentality and their fears to optimize our results. We're not following the herd, but we're paying attention to the herd and their handlers. So I say the herd a lot. What do I how would I define the herd? Think of an easily steered, which is a pun, but to an extent. But think of an easily steered flock of sheep chasing the loudest bell. Sheep will follow that bell anywhere, or a flock of goats. That's why that lead billy goat has that giant bell around its neck, because wherever he trots, that bell rings, and that flock of goats follows. So it's follow the bell. It's fear here and fear there, and rush into this and sell here and follow that bell over a cliff. You can think of the herd like a school of migrating fish, or a school of migrating mullet or bait fish. Once the predators force that school into a ball, it becomes a bait ball. It's a feeding frenzy for sharks and tarpon and everything else. We're not feeding off the mullet. We're watching where the mullet gets schooled or bunched up, and we're going somewhere else. The herd is normally the group that's late to the party or they leave early. It's the group that pumps money into the market late. So it helps us. Like in greed cycle, if you look at the fear and greed index on CNN, the herd is generally late to the party, but they pump money into the market at the wrong time for them. So we swing into greed, and the herd's like perfect, easy money, and they help to inflate prices, which is great for us. But when it moves into fear cycle, the herd pulls money out of the market because they just put money into the market, or they don't want to lose a lot, which nobody wants to lose. That's not my point, but they're more fearful of losing. So as they create panic and further the sell off, we can use that fear to find a really great deal and buy in fear. And if you buy in the greed cycle, then we still demand a discount, or we're going to look into a ignored or just a beat up corner of the market. Uh, so I do have one additional set of disclaimers. I read a ton of material every week. I get emails from Ready News, The Online Investor, Seeking Alpha, Bigger Pockets, Morris Invest, an off-market housing list, plus a lot of random stuff, and then the Contrarian Outlook crew. And of all the different groups and emails and things I read, and I read pretty much everything, unless it's just outright spam. I'm not reading spam. The only things I pay for come from the Contrarian Outlook group because their advice and their insight is worth it. And that doesn't mean I always agree with their take or buy their list, or, or say that doesn't agree that I agree with their take or their buy list or their game plan, or buy alongside them. Sometimes I do. Most times I don't, but I still value their advice. over all others to the point that I'm willing to pay for it. So what exactly are we doing? How do we use closed-end funds, or how are we using closed-end funds? We're building a no withdrawal portfolio that's built in chaos for the long game. Chaos just meaning the day to day, like the up and down in the swings of the market. We want to optimize our buys by snagging the best deals in the current market with a big picture in mind. And we also want to weather the storms. You know the market just like I do. It rises and falls, corrects and surges. We want dividend payers who pay during the chaos and during the normal days and during the surges. And hopefully they kick back special dividends during the surges. We want to supplement or outright retire on dividends while growing that principal, which is very different. And I said that right. Keep and grow your principal and live off the dividends. That's not possible in the S&P 500 or S&P 505 or 503, whatever. It's the S&P 500, but you've got a couple extra companies in there. Okay, that their average dividend is 1.2 or 1.2%, right? But it's a very possible reality to live off dividends in the closed-end fund market space, where the average dividend right now is 8.5. That's almost 7 times higher than the S&P 500 yield. That's crazy, right? We're creating a mixed portfolio of some funds that are here to stay and others that are going to get cycled through based on the market. We want principal increase, and we also want hefty dividend payers so we don't have to sell our principal. Now, most people look past closed-end funds because they can't see the return. And I'll admit, there's dogs in every bunch. I mean, pick your market space, S&P, closed-end funds, ETF, all that stuff, right? Every group has dogs, but I'm not talking about the dogs. The best closed-end funds bring returns, but the majority of that growth is seen in cash dividends and not outright jumps in equity growth or anything else. If you're just looking at the growth charts, you'll pass on a closed-end fund every time. But if you factor in the dividends, you'll blow past the failed traditional investing strategies. So if that sounds interesting, good. Keep watching. If it doesn't sound interesting at all, then I wish you well, and I hope you find your strategy. And if you like my content, just remember to hit the like button and subscribe to the channel. So are there any notes and important takeaways for the last week? Yes. The Fed, and I mentioned it last week, the Fed finally stopped their quiet QE, which is in part due to Treasury Secretary Scott Bessent. The Fed would say they're independent, but they're not so independent as they'd have everyone believe. So the Fed stopped quiet QE. That's good. And inflation went down. Go figure. If you're not printing the money and bolstering the kind of like what I explained last week, if your economy is like a blanket fort and printing money is kind of propping your tent up, when you pull that stick out, you would expect everything to drop a little bit. But we haven't seen that. So the Fed stopped printing money, which devalues money. And go figure, inflation went down. So with inflation down, the cost of goods is going down. And despite everything the corporate media is attempting to do with Get Trump, the new mindset and the positive thinking from the Trump administration strategy is starting to filter through. Drill more, like Trump's drill baby drill, and Bessent is all aboard the drill baby drill bandwagon. So drilling more equals more oil. The cost of making everything from oil goes down. Everything that feeds into tech, gasoline, everything. Like every single semiconductor chip in every single item. This laptop, cell phone, fridge, oven, washer, dryer, like everything, the cost of making those chips goes down. So more oil is good. The cost of everything goes down. The cost of energy will go down. We need a better electric grid. We need a bigger electric grid. We need more power to supply the AI and the tech war. So more oil plus more energy is cheaper energy. So cheaper oil is cheaper gas. Cheaper gas is cheaper manufacturing, cheaper transportation, cheaper consumer prices. And after the Biden regime killed 500,000 chickens for no good reason with an auto pen, and egg prices soared, and the Fed couldn't figure out why. Much like they can't figure out why how they print money and then inflation goes up, or at least they know, but they're not telling everybody they know. So we're seeing egg prices drop. Now, I haven't seen it personally in my area, but I've read the reports across the country. Okay. Now, think about it. Trump's been in office 2 months, 2.5 months. Do we have more oil or more power or crazy cheap gas or 100,000 more egg laying chickens? Probably not. Right? Then why are prices dropping? 77 million people, plus, plus or minus, elected Trump and Vance to bring change, and they are. The bureaucracy doesn't like it because the bureaucracy is losing money and power and control. But those 77 million people, and I'd argue it's more now with Doge exposing all the waste, fraud, and abuse, that voting majority love it. And the thought of those changes is bringing a ton of hope. And hope is a very powerful thing. So if you look at the market looks forward like a stumbling toddler chasing a toy. And the toddler has hope that he'll get the toy. Now he'll fall down a lot, but he's going to get back up because he sees that toy and he has the hope that he will eventually get it. And despite the tariffs, which aren't inflationary, which also Jerome Powell finally admitted last week, quite honestly, the two most inflationary things we've seen over the last 4 to 6 years have significantly been curtailed or shut down, meaning the Fed stopped printing money and the bureaucracy isn't spending money. The Fed inflating money and the bureaucracy spending money are the two biggest contributors to inflation. And we're finally seeing that slow down. And despite the herd's bell ringers talking about the end of the world with a possible recession, I'm not really concerned about that. I mean, I'm ears to the ground about it, but it really doesn't have me concerned. We'll either have a no landing recession like what we've been talking about, where the GDP drops and the economy keeps chugging along, or we'll have a real recession and the housing market will finally calm down. We need that. Home values have skyrocketed and pay has not. Whether you're a homeowner, a leaser, a renter, or a property investor, we all need a break on home prices. So now think about all that as we sift the list for the week. So where should we be investing in the market? Consumer stocks? No, way too volatile. Tariffs don't cause inflation, but tariffs cause companies to be more competitive. Okay. You'll hear it get spun as a tariff war, but it's really forcing companies to get more creative in how they compete. Tech, unless you can scoop a duel, or unless you can scoop a deal, there we go. No. Oil, more oil might drop oil prices or widen discounts, but that hasn't hit noteworthy levels yet. Natural gas is still above a $2 mark. Bonds, yes, for sure, yes. So with Bessent and Trump focused on bringing down the 10-year Treasury rate, which has already dropped since Bessent got confirmed, and along with any sort of potential recession and the Fed lowering rates, bonds are a good idea. So if rates drop, bonds and their proxies will rise. And as it stands, bonds are a great place to be before rates drop. Now, what if rates don't drop? What if the Fed tries to hold power and goes higher for longer, or at least maintains for longer? They're still a good buy. I mean, they'll do better when rates drop, and I'd want to already be there. Truth be told, we are already there. Uh, but you gotta remember the herd. The herd's going to get steered wherever their bell ringers want them to go. So if we're if it gets spun, right, that it's like, oh no, recession, the herd's going to look away from the stock market and outright equity growth over the next 2 to 3 or 5 years, and they're going to look into something that's more sure, something that's more certain, something that's more comforting. They're going to look to bonds, and they're going to look to dividend payers, somewhere where they can make money regardless of how volatile the market gets. So the herd will pump money late, but the herd will come in and they'll come in late, and they're going to come in looking for secure dividends, and they're going to come looking for bond winners, and they'll pick anything. They'll pick what their people tell them to pick, but they'll also pick anything, right? And that's good for us, probably not good for them, but they'll close discounts, they will buy up shares, and they will help lift prices. And all of that's really good news for us. What about energy and energy transfer and utilities? Those are bond proxies. So, as do bonds, so do bond proxies, plus all the needs for electricity and the grid. So, think of this. I debated about how to do this list. So, I think I'll say everything and then go back. So, we have all these needs for electricity. We have the grid in general that needs to get bigger. We have AI's demands. And we have everything else we have to maintain that's already in place. So the grid is outdated. Wherever you are, people complain about the grid being outdated, and that's true. We have to update the grid with better products and new technology. We also have to expand the grid. So to win the AI war, the US needs to create as much energy as the size of Japan. That's a lot. And for the AI demand side of things, ChatGPT uses 10 times more energy than a Google search, and it cuts out all the paid for crap at the top of the list, and it gives the results uncensored like Google. That's pretty impressive. Me, I like both. I like ChatGPT and OpenAI. I still Google search or DuckDuckGo or pick your web browser because I kind of like everything on the list. Um, but that's just me. So as an investment, though, looking forward, that sounds like a great addition if you can find a deal. And the noises you'll hear in the background are, I mean, quite honestly, it's Sunday and we're prepping the week. So my family's moving about me as I make this video. Real estate is another bond proxy. So with rates, gosh, with rates poised to finally drop, real estate looks better and better. That's on a national scale, but that's also on a global scale. So throw in cheaper cost from more oil, a slightly lower demand through ice deportations, slightly more supply, and we're set up for a real estate boom. And I don't want I mean, gosh, I want the real estate market to catch up. I want the boom in real estate where we are tracking, like where, gosh, where I want people to be able to find a house at a decent rate. I want businesses occupied and I assume it's the same in yours. In my area, we have all these little mini strip malls that are built and there are no businesses there. And then you drive a quarter mile down the road and there's an old strip mall with three-fourths of it full. And then just beyond that, there's a new strip mall that's completely empty. We're going to build all these little business places. I want them to be full and running. I mean, the commercial real estate is growing, and it's still trying to adapt itself post lockdown and office space versus work from home, all that stuff. Uh, like I want the real estate market to boom because if we can get if we can get more oil cheaper, then everything does better. I mean, transportation, real estate, manufacturing, like everything does better. It's the market itself, honestly, is just scared about tariffs because their handlers are scared about tariffs because their handlers are losing money from all the kickbacks from USAID that's not paying the money anymore. Um, and as much as I want the real estate boom, I also don't want my property tax rates to reach the stratosphere because, again, value went up, so your taxes are going to go up. I don't want that. Um, all right, so enough covered, I hope. So let's get to filtering and sorting the list. Let me see. Share screen. All right, this is the closed-end fund master, right? And normally it's alphabetical when I update everything. But how it works, and that's just my contrarian outlook link. Uh, so one asterisk means I track it for any number of reasons. Two is a dollar cost average alert, meaning we already own it. And three is a buy alert. And it works out, says as I hover over the box, we're looking in how I do buy alerts, or say how I do a triple asterisk, or even this. So we want that discount to be double the 5 year. Oh, let's find there. We want that buy alert to be double the historical and greater than the 5 year discount. And pending the fund's uniqueness, like HFRO completely changed their portfolio about 3 years ago. HGLB restructured about 4 years ago, about 6 years ago. NBXG is relatively new. And and closed-end fund investors love discounts. We love discounts, we love deals, we love the dividend. But most of that of honestly, most of the closed-end fund market space, the investors don't like change. They don't like newness. So when new funds come on the market, pending on what's in them, pending who owns them, pending a lot of things, they will hesitate and pull back and not invest in them because they want to see how things go. Because you're looking for a safe, secure dividend that's going to grow, but also a principal that's going to grow over time. And nobody wants to take that initial risk. It's like when new technology comes out, you've got to, or when new technology comes out of that bell curve of people, you've got 10% that's like, yes, I'm all for this. And you have 10% that are like, I'm not going to touch that unless I really have to. And that 80% is what most companies push into because that 10% is going to come find them regardless. But if you can sell your company and sell your product and sell everything to that 80% and pull the majority of the 80% towards you, then who cares about the 10% that's going to wait till the cows, until pigs fly and the cows come home in order to invest in your property? And closed end fund investors are the 80%, or they lean more of that middle bell. They are the 80%, but they're also skewed closer to the 10% that aren't going to invest until pigs fly. So pending newness of company, pending ownership, pending what's in it, pending overall plan. If you can find a new company pretty cheap that sells an awesome, that pays an awesome dividend, and be willing to go where no one else is, you can find a really good deal early before even the closed-end fund investors invest in it inside the closed-end fund market space. And that's kind of NBXG. NBXG is a relatively new fund. And I'll enlarge this. There you go. And then you can pause the video and read it. NBXG is a pretty new fund, and there are people that are hesitant to invest in it because of how new it is. Go back over. That way you can see this. So the existing discount is a little lower than the three year and the 1 year, but it's still in the game. Like it's still close, uh, and it's still noteworthy. Maggie's discount is more based on the 1 year average. Same thing. You can pause this and read that. But in, let's see, this. So we're looking at historical and the 5 year compared to the current discount. So we want double the historical and then greater than the 5 year. So in premium territory, if I just go A to Z on the list, and we come down to break even. Let's see, no true break evens, but we have two funds that are close. So in a break even where it's zero, It's not premium, it's not discount. For every dollar you're investing, it's it's like for every dollar invested, it costs you a dollar. If it's premium, like this, for every dollar invested, it's really $1.01. Now you could argue that the 1 cent is not that big a deal, but most people want the discount. If you have the option to pay 99 cents versus a $1.01, most people want the 99 cents. So on the premium end, you can go up crazy high. And I'm decent at math, but this math conversion is interesting. So on a dollar, so this is like FCO is like paying $1.80 for every dollar invested. And I don't know the math conversion for that offhand. Versus HFRO, instead of paying a dollar, you're paying 43 cents for every dollar invested. So the whole, which I don't know why my eye suddenly went into irritation mode. Um, I don't know if you see my video at the corner or not. We're looking to score discounts, but not every discount is worth it, and not every dividend is worth it. So we want to be extra choosy in how we pick our funds. So I sort by discount. So everything that has a buy alert has been filtered and sifted, and we have dollar cost average of what we already own. So especially if it's cheaper than what we paid for it, and then we have every fund we're tracking. So what I do in preparation is I update the fund or I update the list every week of all the color coded. So light blue we own in a cash account. This blue we own in a Roth. Purple is recommended by somebody I trust. Green is I track for any number of reasons. Yeah. Gray doesn't meet the metric. And you can see the values at the top. Gray doesn't meet the metric. White is kind of indifferent. So I sift the list, identify the targets, create a new tab in the spreadsheet, deposit the list, and now of this list, so we're looking to optimize our money, right? So these are the most significant discounts. So now we want to further filter the list. We're going to use this as our guiding principle. Oil is interesting if you can find a discount. Tech, the same. It's discounted, but it's got to be significantly discounted. And quite honestly, oil is more expensive now than where we picked it up 3 years ago. Tech, same idea. So we're looking at bonds, loans, BDC, business development company, utilities, energy transportation, and real estate. But before we get to filtering that, we're going to further filter the list. So everything is a target. Everything has a significant discount. We want monthly payers. ADX is tempting, but not quite in this market for two main reasons. It's blue chip loaded. It's going to be volatile. It also doesn't pay a dividend until May. And it used to be a hidden yield in the sense that it's quarterly. So it would pay 5 cents. I think it's 258, or maybe it's 25, maybe it's 259, something like that. It's not a straight category 2 or 3. Uh, so it paid we'll say it paid 5 cents a share, 2, 5, and 8. And then in December, it paid a fat, like special dividend almost. It still paid the 5 cents, but then it would pay a special dividend of $1.95 or $3 at the end of the year. And then they changed that. This past December, they paid $1.96 a share. But in September, I think they paid 47 cents a share. In February, they paid 44 cents a share. But currently for May, there's 5 cents a share. And it used to be like clockwork. It was 5, 5, 5, and whatever. And then they changed it. So I don't know if they're going to continue that and change their dividend not so much policy, but change how they're paying dividends, kind of spread it out more. Or if they are just going to pay the 5 cents for May. Uh, but if we bought it now, like the May dividend, it's not ex dividend until the middle of May and then it pays at the end of May. So owning it right now just means we hang out for 2 months until it gets paid. And as of right now, it's just a 5 cent dividend. So the yield here is listed for the overall year versus this has the dividends as they've been paid. So right now, no. In the future, maybe. All right. That's our only quarterly. So now everything's monthly. So now we get into overall yield. The goal is my goal, my individual goal, my personal goal is 9% above, 9% or above, unless something does present a better, something presents a great option at a lower dividend, and you've got to be able to justify it. So if we look at the discounts, yeah, sure, we'll go reverse. If you look at the discounts, everything's in discount except for two companies. So the more I dig into the list, the more I find exceptions to the rule. And two of them make the cut for the week. So DNP is an exception. Well, really, all three. I mean, ADX was here, but it didn't stay. So DNP is a utility company, and it's almost always in premium. So you're really not going to find it in discount unless you're just lucky or fortunate. So you have to take the existing discount and compare it to the overall, say, really the 52-week average to get a good look at overall pricing. So if we're looking at the existing discount, that's the lowest it's been in a long time. So if we look at the year average, it's around 8. Current average is around 3. Even though it's not a negative discount in the sense that FCO is here at 180, 179, it's a discount for the fund. And I could actually make a case for buying DNP, whereas last week I could not. Uh, this one, I forget which one, PDO, is the same idea. It's really never or rarely, I guess never is not the right one. It's rarely, super rarely in discount territory. And it's a bond fund. So if the current discount is close to or beats the 52-week average, then it's close to being in discount. And right now, it's, I mean, based on 419, 5.3 is still higher than that. But you could make a case for it. On our end of things, we already own several bond funds. So to buy a bond fund in premium, and I get it, like my spiel, my shtick has been buy discounts. Uh, and if that discount dropped to equal to the 52-week average, that would be break even, or slightly lower than the 52-week average, that would be a discount based on the company. If it dropped to something under that 3-year discount, then it's actually a significant discount for the country. I could make a case for it, but since we already own bond funds, we could already buy the same bond funds. I'm not for adding another. I like the idea of diversity. I don't like the idea for diversity's sake. And that's the whole concept of with butter scraped over too much bread. If you like butter, if you like bread with butter and you don't have enough butter on your bread, it's not enjoyable. So PDO for me would not make the list. Maybe it would for you, but it doesn't make my list. So let's go back to yields. We already own municipal funds that are great dollar cost average buys. So I can see us adding more of these funds since we already own them and they're great dollar cost average buys for us. I could see adding more of them to our portfolio this next round for that purpose. You get tax-free income. gosh, you get tax equivalent income. So you get tax-free income. Um, 7.8 is still pretty darn good compared to 1.2, and that's not including the tax equivalent dividend. They're great dollar cost ads for us. I mean, they're close to or slightly less than where we bought them at. Strategically, that makes sense. But if we're going to optimize our money with that in mind, they don't meet the metric, so they wouldn't meet this list. But we already own municipal funds, so it doesn't make a lot of sense for us to add more just to have more. Let's see. Utilities. How you view the how you view the value or the cost or the worth of the dollar matters in how you invest in the market. If you think the value of the dollar is going to go up, less inflation, or if you think the value of the dollar is going to go down, more inflation, kind of swings how you invest in the market. Now, if you take the current mindset, current policy shift of Trump's administration, which is very pro USA, onshoring manufacturing, putting a tariff on anybody who's trying to put products inside the U.S., you can go for a global market if you want. I'm focusing more on U.S. investments. So a majority of investments outside the US does not appeal to me. In the long game, maybe that would change. Maybe. I mean, I have no idea what's going to happen next in the presidency realm of things. But currently, that doesn't really meet my focus. So this would not stay. We already own the other Sabbath investment. This used to be just insanely government focused. They've changed it and updated it. Uh, and honestly, I like BRW better. So these three on the end are all municipals. We already own municipals. I'm going to come back to ERH. Same thing. So we're already invested in bonds. You have collateralized loan obligations and senior loans, bonds and other assets, mixed bonds. Adding another bond company for the hell of it just doesn't make sense to me. Real estate, we're already with a Cohen and Steers fund, adding another one that costs more than where we currently are that pays about the same amount does not make sense to me. HFRO stays, it pays less than 9%. It's paying close to it because the value of the fund has dropped, but at the same time, I still see light for the company. The more square footage they get online, the better it is for the company. And I will go back to this. That way you can pause the video and see what all is here. But for me, I'm still willing to invest in HFRO. These three are all stock, like outright stock based. Newberger is tech, or NBXG is tech. It's all stocks. Uh, it's tempting in the set, like it's valued more than where we bought it. It did dip. I want to say it was high as 1380 maybe. So it still dipped. It's still well under what it used to be, but we're still going to see more volatility, and especially as more AI updates come out. Like we had the initial AI update, and then we had Alibaba's AI update, and we're going to see more of that. So it's just going to be a volatile market space. So if it dips to a price of where we bought it, or even less than where we bought it, that's a good pickup for us. But right now, not so much. I talked about this last week. CIF and FCO operate on different sides of the overall company valuation pendulum. Not, it's nothing to do with how they behave as companies. CF, it's like small fry and big fry. Like of the pendulum, CFS has maybe 50 million assets right now. FCO has maybe 2.5 billion in assets right now. They're doing very similar things. What sets this one apart is that I think this one is, yeah, see, almost 100% US market investment. And this one is all American investment. That's one difference. The other is FCO has a private lending feature or a business development feature. And I like that because Scott Besson is very pro small business. So having a BDC embedded inside your loan company or bond company, that puts you above the competition, or it puts you in the competition, but it also makes you better than the competition because you can do more. You can do more to invest. You can do more to get more money generation coming into your country, and that works better for me as a shareholder. I I bought CIF knowing it would be a roller coaster. CIF's track record seems to be every 2 to 3 years it swings. It's based on rates and everything else. So I bought CIF low, hoping it would swing high, and we are riding the roller coaster. Now, they pay a great dividend. I mean, they pay a 10% plus dividend. Me personally, I'm hoping that lower rates, right, bring more people back into the bond market and then elevate the company's price because when it gets to 2.5, 2.75, $3, we would sell it and then carry that money forward and do something else with it. FCO is still a discount, but so why take CIF off the list? Why take it off the list? It's super cheap, pays a fat dividend. It's about the same price where we bought it at. All of that's true. But if I'm going to pick between these two, I would pick this one because it has more uh, money generating features with it. That being said, 715 is pretty steep compared to where we bought it at. And we've bought it in both the brokerage, which I'm so of our former fiduciary at Morgan Stanley, we took all that money and we put it in Fidelity. And we're currently investing it in allotments. Like we did invest everything at once. Did I? Yeah. So with Fidelity, our average, we'll say it's 6.93. That's close to 715. But even so, I mean that is a bit much. And I realize I have not updated these. Crazy weekend. So 715 is closer to 693, and the Roth, yeah, 630. 715 is a lot farther away. Yeah, so we opened this Roth last April. So in a year, in less than a year, we're currently like 11 months into the year. We are, gosh, almost 20% up on some funds versus this one, still the real estate market. We're about 5% down, but we're getting safe with our dividends. That's about the same as last week. That's more than last, or now, yeah. So in hindsight, I should have gone back and updated this, but yesterday I didn't have time and I lost track of it today, so I apologize. It's been a crazy season. There's a lot that I should have been like there's a lot on my plate that I was hoping to get done. The full explanation of closed-end funds, why we started Roth instead of a traditional IRA. Gosh, the more consistent update of this list. It's just been a really rough season in the sense it's not been bad. My daughter's group is busy almost every weekend, so it really cuts into the other time frames. So you have to optimize what has to get done, like prepping for the week. And sometimes on my end, this stuff falls short. So I apologize. Um, I'll get better at it. I'll get better. Um, Let's see. FCO. So if I had to pick between the two, and honestly, if you didn't have if you don't have a ton of money to invest, CF sounds great if you're willing to ride the roller coaster. However, that being said, the more I ride the roller coasters, because the ZTR fund that we already have, the GLO fund that we sold, and then this fund, having ridden the roller coaster more, I don't like riding the roller coaster. It's a great hope and uh, it's almost like buying Nvidia. Like you're if you look at that Nvidia chart, it'll spike and then it'll drop. It'll spike, it'll drop. It's the same idea. You're just riding a different kind of roller coaster. Um, it sounds great, and it's great when it hits that summit and you cash in. But riding the roller coaster there is, and honestly, I'd rather invest the money there. Um, FCO, are we buying FCO this week? It's tempting because it still is in discount territory. It's certainly the it certainly presents a better money generating feature than a traditional bond company. Uh, but I don't know if we'll invest there or not. Maggie makes the list. And a while ago, I had somebody on YouTube say, "Hey, what do you think about Maggie? This, that, and the other." And Maggie has stayed off our list. Um, and the same thing, you can pause and read this. Now, it's supposed to be a term fund. It's supposed to end in about 8 years. And in general, of what I can see, the discount is always the discount is not always as wide as it is now, but it's generally been in discount territory. But it's really only interesting when the discount gets close to or exceeds the 1 year average. And currently it does. So that's interesting on our end. This is a mix of things. I would buy this week. I mean, we're at our next between this week and next, we're at our next uh, buy point in the Fidelity portfolio. I would buy HGLB just because of what's in it and how the market is. It's stayed consistent in pricing, which I mean I get it, which sounds weird. It's had a fairly consistent price, but at the same time, it hasn't significantly dipped in the market, and it also hasn't risen in the market despite this crazy dividend. So I would buy that. Me personally, I would buy that this week. It'll stay on the list. River's the same thing. We already have bond funds. It's really hard to justify buying another one, especially one that's more expensive than what we currently have. Same thing for these two. Now, Hicks, high debt security, uh, but it's not noteworthy in price, noteworthy in dividend, but it's not exactly outpacing the field. And then this one, same thing. We've already got bonds. So now we're down to this. OXLC is interesting. Now, I forget where I read it, but of the different articles I have access to on the Webull platform, which is something I like about the Webull platform. Um, of the different articles that come up based on the different funds, so whatever article it was like, don't buy, don't consider. What was it? If you're looking at OXLC based on the dividend, pause because if the labor market softens, the company might not do well. Now, depending on how you view the labor market and how you view the Doge cuts, and of course, my neighbor would start mowing his lawn right now. It's been quiet all day. Of course, he would start mowing it right now. Um, Depending on how you view the Doge cuts, there's going to be a surge in the labor market. The government has close to 5 million official government employees. There are 15 to 20 unofficial government employees through all the different contracts and NGOs. Doge is working to curtail the massive bureaucracy. So we're going to lose some government jobs, whether directly or indirectly. Now, doing so will put more people in the labor market. but that also helps the labor market. Now you've got more qualified people, whether I like the job they've been doing or not, they are quite qualified in spending money. So they will find a job with somebody who also likes their track record and their ability and their history and their experience. So it's not that I think our labor market will become bloated, but we are going to have more people looking for a job. Now, the news will spin that we have a really soft labor market, or our unemployment rate is going to go up. And we, even though I don't like the herd, even though I don't follow, uh, even though I don't buy into who they're listing, they still influence the herd. So they'll see that softening labor market. Oh my gosh, avoid that company. Versus on my end of things, I don't really buy into the stuff, and I know how that's going to go. So when OXLC hits discount, whenever it hits discount, regardless of the market at large, that's a tempting buy to me. OXLC has not arisen back to where it was before lockdown, and their dividend has changed over the years, but it's still a climbing dividend. So softening labor market or bloated government, however you want to say it, when the share price dips and this actually hits discount, that's tempting. And I get it, it is a crazy yield, but they have maintained that yield. So this one would stay on the list for me too. BRW, it's a shareholder activist fund in the sense that it's advocating for shareholders. Me personally, I don't want to buy BlackRock because of all the stuff. But BRW will buy BlackRock and a lot of these other funds and then take over the board and force them to increase the dividends so the shareholders make more money. I like that. Uh, and that pricing has stayed relatively consistent. It's higher, I believe, than where we bought in. 774. 774 is a little less than Fidelity. Let's see. And on the Roth, it's higher, but at least it's consistent. So I would leave it on the list. So what I haven't talked about is ERH. So there's three utility funds on the list. There's MEGI, ERH, and DNP. And I have advocated against DNP in the past because it's just a flat dividend. It pays, and it pays regardless of the market. It high rate, low rate, crazy market, lockdown, whatever, it pays, but it's not exactly going up. Maggie has a crazy high dividend that I believe they've raised. ERH has a very sporadic dividend. It's not the same month to month. It's extremely inconsistent. So that alone makes DNP and Maggie more interesting to me, especially playing to our bonds and bonds proxies. Bond proxies right now I mean, they're probably a little bit more expensive overall compared to where they were maybe 3 to 6 months ago. But the discount has finally opened to where it's significant. It's interesting to me. But in the dividend game of things, we want consistent dividend payers. We want a company who can maintain. And ERH is not consistent. Now, it looks interesting in the sense that it's slightly more than DNP. But will it be the same thing next month, or will it drop, or will it rise? Like everybody wants it to rise, but nobody wants the erratic, maybe that's a word, maybe not. No one wants that erratic behavior in a dividend payer. So that's not interesting to me. The other thing it has against it is I've had an all spring fund before, and I'm not a huge fan of how they do things. So it doesn't make the list. And in this case, DNP would stay. I get that it's premium. I mean, I get that it's like paying $1.03 instead of a dollar. When in the grand scheme of things, $1.03 is still cheaper than $1.08. So this would not make the list. This is the list. Now, if we had to get really choosy, 715 for FFCO is, yes, more expensive than it has been, versus all of this is that like, yeah, that's a little more expensive than it was 3 to 6 months ago. Same thing for that. But of the others, that's cheaper than our buy-in pending portfolio. That's cheaper. This is more expensive than the Roth, but cheaper based on Fidelity's brokerage. That's about the same. That's more expensive. That's cheaper. If we really had to trim it, and we were like, if we, gosh, I like FFCO, not FF. I like FCO. But if we look at, and it's that same thing, FCO is super new. So it opened with this crazy wide fund, right? That was a long-standing private hedge fund, went public. Uh, CEF investors were hesitant to buy in. I'll highlight this. Um, they were hesitant to buy in, but now they've seen the company and the structure and what they're doing. They're more buying in. So 715 is not expensive, but it is expensive for where we are. Roth, 715, Fidelity, right? 715, a little higher, not bad. So maybe at the Fidelity fund, definitely not at the Roth. There we go. So I'll keep it on the list, but it's kind of iffy. Like maybe it goes back to justification. Can you justify doing it? I can justify doing it, but maybe it is just a little bit too high for us of where we are. Maybe it's a great deal for you. So of where we are in the scope of things, the Roth, we're not in a position to invest. In the brokerage account with Fidelity, which, and I finally did it. I finally broke down because people ask me what we own and what we have. And I'm very willing to be transparent. Here's what we own and what we have. This is at Webull. We've had the Webull account from about, we'll say like 321. We've had it about 4 years. Um, see, we look at total ROI. Um, so I finally went through and just went ahead and did it to where we move this portfolio to Fidelity, and hopefully it gets there by end of week. Same thing with a Roth. We bought our last round of shares between FCO and HFRO. Um, yeah, so I mean, the individual fund we've had for about 4 years. Gosh, pretty decent ROI. Roth fund we've had for about 4 years, pretty decent. Or Roth fund we've had for less than a year, pretty decent ROI. Really split between overall growth and dividends, and that's kind of. I mean, most people would track individual fund growth in the bond fund, like depending on when you hit the market and time them. There's no timing the market, right? But depending on what you're investing in, whether you're investing in what you need to invest in at the right time. Like right now would be a great time for bonds and not a great time for stocks. Uh, Depending on what you're investing in and what risk you're willing to take, right? I mean, that really impacts the overall portfolio. We've done pretty decent at that overall. And the Fidelity numbers are not accurate for the week, but as they were last week, pretty break even. And I'll admit, yes, it's negative, but at the same time, for being open for about 2 months, it's pretty even. So for this week, what would we invest in? Honestly, so since I'm investing in Fidelity, I'll be honest, since I'm investing in Fidelity or in our Fidelity account, we have more money available. Almost all of this is fair game. I mean, if we tack on the three municipal bond funds, that creates an issue because there is only so much money, right? That like this is Not applicable. There's only so much money, and the more funds you're trying to buy spreads out your money and really limits your impact. So you have to prioritize what you want to invest in. So if I really had to clean up the list and shorten that, then that's where some of these fund like this, I love the fund, but if we're trying to optimize what we're doing, getting the best bang for our buck, I guess you could say. Um, like we're looking at like if we're adding the municipals, then it's this list plus three that aren't pictured. Okay, then that would mean FSCO has to go. Um, Now we're left with senior loans and collateralized loan obligations, a kind of a hybrid fund, I guess you could say. Not quite a portfolio in a can, but similar. Same thing. The If I'm going for mainly US investments, it's hard to keep that same mindset when you're going with utility funds because they invest all over the world. ERH would not, maybe PDT would even come back and make the list, even though, where are we? PDT really could come back and make the list if you could justify it because it's got 40% US investments compared to what's still on the list. The holdback is the dividend, at least for me. Um, yeah, so meaning so PDT's got 40% US investment. This one would have 33% US investment. If we're prioritizing US investment, yes, but at the same time, that gets harder the bigger the company and the more, especially for energy. Um, and in a term fund, it's interesting. Term funds would mean you buy it at this, whenever it liquidates, you get it for whatever the NAV is. So if you bought it today, if you bought it Monday and they sold everybody out, and they sold out, you would buy it for 318. But when they sold the company, you would get 486 for all your shares. Essentially, you get like $1.70 more per share than where you bought it at. That presents an interesting conundrum because I like these two other companies. So what I have to weigh out is, and it's the tax equivalent dividend. Uh, it's very tempting to buy this set of funds. It's also very tempting to take these two off. So the blue we already own inside the Roth, and we own HFRO, FCO. We own these four, which are harder to see, but we own five, six, eight, and nine in Fidelity. OXLC would be a pickup. That would be new. Um, Seven funds is round about what we bought each round. I want to say we've tried to go for maybe 5 to 6,000 per. Oh, that was 15,000. This was about the same, 14,000. So at 14 grand, and here's the deal. So you're looking to split, and I don't know if this is you, but so this is me. This is what it's been. 14,000 split seven ways is 2 grand a firm, right? 14,000 split 10 ways is 1,400 a firm. So at 1,400 per firm, you're looking at 50, give and take. Me, I mean, if you follow me, you know I like stuff. I like sets in 50. So 150, 250, whatever, or just even flat 100. So that's at 9.6 already. So plus three others. I don't know. I have to play with the numbers more. So if we're not going with municipals, this would be the list. Um, if I'm adding in municipals, then I quite honestly have a lot more to weigh out. Um, and I don't want, and I could make the video a lot longer and give you all the rationale and hear my ramblings and hear my defense and hear all of that stuff. But that would make the video a lot longer. And that's not in my interest is giving you data, giving you my input, and then not drawing it out longer than it needs to be. So if we're optimizing in the sense of the municipals or dollar cost averages, then it's great justification long term. Like it's a great pickup move for us, but it's not. How do I say this? They would make our list for the week in the sense of they are dollar cost average buys, but this list is really like if we could, if we weren't buying the dollar cost averages, it's optimizing the list the very best we can. So this would be the final list for the week. OXLC, taxable senior loans, CLOs, BRW, the activist CEF fund, so bonds, stocks, closed-end funds, precious minerals, uh, gold, etc. HTLB, which is not quite a portfolio in can, but ticks the majority of our boxes. Meggie, um, I don't. What I get away at is 100 shares really worth it overall, or is it just better to go with a different company? FCO, uh, bonds, loans, BD, well, bonds, loans through the BDC, All American, HFRO, everything real estate, and then DNP, utilities local and utilities abroad. Um, so I don't know. Give me your thoughts. Give me your feedback. Um, I really do. I've got to. I don't want to take your time, and I need to figure this out before we invest this week. But as always, I'll show you whatever I did, and I will justify whatever I did. Um, it goes back to if you can't justify it to yourself, if you can't explain it to somebody else, it's probably not a good idea for you. So this is the list for now. We'll see if the municipals come back before we invest for the week. And really, that's all I got. So if you've been with me this long, thank you for staying around. I know it's a ton of info. I tried to explain how we sift the list and why it matters. Several people have asked about that. It's just it takes a little bit longer to get through all that. So if you like all the content, thank you for staying around. If you like the content, consider subscribe, consider subscribing to my channel. Hit the like button. It really does help push videos out. If you want to find me day to day, you can comment on a video, really comment on any video. I get those notifications, or you can find me on Facebook at Navigate Your Finances. And I'm trying to think if there's anything else. Yeah, whatever we decide, whatever I decide, I'll let you know in the next video. But whatever you have for the week, I hope it goes well. I hope everything you have goes well for the week. And on my end of things, I've got to get better at updating my list and being more consistent. The day to day, week to week drag for this season of us has just been a lot, and it culminates next weekend. And it's also my weekend to update the list. So we'll see what happens and what gets done and doesn't get done. But whatever you have for the week, I hope it goes well. And I will see y'all on another video. Have a great week, everybody. Bye.